All right. So it's been brought up about insurance companies now, especially with the wildfires going on in California. Um, Insurance company is a business. Their business is to make money, and they weigh risk models to come up with what their premiums are, so that at the end of the day, they make money. Insurance is not a privilege, but it's a mechanism that is created to guard your investment. This is what bothers me with some of these claims, like, oh, the insurance companies pulled out. The insurance companies pulled out because nobody could afford the insurance anymore. Every state has an insurance guidelines that kind of govern, so the insurance companies don't go crazy on how much money they're making or how much they're charging. But in some cases, like California, some of these insurance companies needed to charge upwards of $500,000 a year. I'm not joking, $500,000 a year to maintain coverage. People are like, well, that's so expensive. But the insurance company is the company that's bearing the risk. If there was wildfire, they have to come up with the premium, not the premiums, but the money to resolve that. Just because you want that beautiful house, and just because you want a home and you want it to, you can't, it's not your just because you want that beautiful house, it's not your privilege to have it protected from all things that can happen. So insurance companies come up with models for risk, okay, and what those risk models are. There used to be one or two companies that do that for them. Now there's dozens, and even when it gets into property specifics, it gets into there's a lot of companies that go in and create these models for the insurance companies, and they use variables like natural disasters, right? Like, what are the chances that the homes are going to be near a fire? Well, in California specifically, it used to be like 1 in 500 years, but recently, in the past over, I think, 2 years, it came down to 1 in 20. So the environmental hazards came down that there's a 1 in 20 years chance that that property, whichever one it was in LA or in those areas, are going to burn down. And so they have to increase their rate because they have to make money off of this and also minimize their risk. There's other disasters or natural disasters that are, if you're in a flood area, are you near wildfires, are you near earthquake area, hurricanes, or even, like we know, tornadoes. Crime rates pay into the fact. If you're in an area that has higher crime for vandalism or theft, that's going to increase your premium. Environmental hazards, like being next to, in a flood zone, or by in Florida, for instance, where it floods up in the downtown area, but being next to big bodies of water or unstable grounds. Also, property condition. How old is your property? I'm in a 1950s house. Its premium is going to be a lot more than a house that's built in 2024, because the risk of things happening in an older technology, older built home are higher than in a newer built home. Maintenance. Sometimes insurance companies send uh, assessors to go to people's homes or properties like office buildings and retail centers to look and see what the maintenance history of the places. If it's well maintained, it's lower risk. If properties are disrepair, it's going to be higher risk, higher chances of claims. Building materials used, like roofing, siding, foundation. If it's flammable or inflammable, the technology now it has that the siding used to be wood siding, then it came aluminum siding, then now a lot of people have the concrete fiberboard as siding. Brick is not going to burn, but wood will burn. So if you have a brick home, your insurance premium is going to be less. Also, they're going to check and see who you are. What's your claim history? Have you had any claims on your auto insurance? Have you had any claims on other homes? And how the frequency of those claims are going to be. That what is the likelihood that you're going to claim anything and everything that happens, the hail damage or a broken window or a theft. Your credit score, how well you pay your things, how well your financial responsibility is, also matters, and it plays a direct role in what your premium is going to be. Insurance history. Do you have any gaps in your insurance? Like, did you at some point couldn't afford insurance or didn't pay for the insurance? Also, property features like swimming pools, trampolines, even pets. If you have pets like dogs, cats, or whatever, your insurance premium is going to be a little bit higher. Security features. Do you have alarm system on your home? Do you have sprinklers? A sprinkler system on your home? It's a lower risk. Hazardous materials, like if your home is built prior to 1976, you may have lead-based paint, you may have asbestos. Is somebody gonna come by your house and make a claim against you because they got asbestos poisoning or lead poisoning or something of that sort? Also, what type of occupancy, right? So you have people that's your primary residence. You also have people that have a second home. Is their house empty? Is nobody there? That's higher risk. Is it a rental home? Also could be a higher risk because there's more people that can claim against you. Um, your we talked about your maintenance habits, lifestyle factors. Are you into like risky activities? Sometimes when you're getting these big policies, um, and they see a trend in risky activities on you, they're going to know that if you're going to be having risky activities at home, parties, lots of people invites, but that's going to be more on very, very high end when they get very specific on properties. And so the insurance companies will do risk mitigation measures. They're going to ask you sometimes to replace your roof, or hey, your home is not going to be, we're not going to cover you on flood insurance unless you insert culverts around the house. And then also they check in with local regulations and laws occasionally. Is your house up to code? We want to see an inspection report. Do you still have aluminum wiring? Or do you have copper wiring? Do you have iron pipes, or do you have PVC or the plastic pipes? And then again, what type of premiums, or how big of deductibles do you want? What is your policy limits? And so those are all risks that are involved. And when people are like, "Oh my God, the insurance companies pulled out," insurance companies pulled out because the properties became more risky, and the premiums were so high that the limitation in California on what they could charge wasn't enough to cover the risk. And so the insurance companies aren't in there to just be your right to insurance. The insurance companies are there to make money. And if they see the risk is too high versus the reward of profit, then they pull out. After making that last video, I decided to make a insurance risk variable cheat sheet. If you want to download it, click here or email me or grab me from one of our social media sites.